U.S. equity markets have not had a good start to the year in 2022, but where can we be headed from here? Joining me today is Brian Belski. He is a chief investment strategist at BMO Capital Markets, and he is here to discuss with us his outlook on stocks and the macro landscape in the U.S. and Canada as well. Brian, welcome back to the show.
Thanks so much for having us.
Brian, I want to start with the big picture first. Economists are worried about another recession that is coming on the horizon. We don't know when exactly, but it's looming on the horizon, they say. And when it does come, it'll bring down equities with it. What do you think?
I've learned a lot of things in my now almost 33 years on Wall Street. And when everybody's saying one thing, go the other way, I can't believe conditions are not even near present for a recession. So that talk has to absolutely positively stop. My grandmother taught me a really cool word, bunk. It's all bunk and it's all fear. And these people making recession calls, by the way, are the ones that have missed the market, especially since 2020. But many of them are the same ones that have been calling for a correction for the last 10 or 12 years. So there is no recession imminent. No way.
Well, growth is slowing down. The GDP forecast, the numbers.
Of course, it's slowing down. My whole notion, as I said in the beginning, positive is still positive. You can't have 6 to 7% GDP growth with near free money. But if you still have interest rates and a Fed funds rate below 2%, below interest rate, it still is a great environment with double-digit earnings growth, low interest rates, and a consistent earnings environment. That's a beautiful environment to own stocks. So you can't have it both ways. You're not always a buyer or a seller. You can't say binary, growth is slowing, growing in a recession. That makes absolutely no sense.
Are companies ready to weather the inflation storm, you think?
Well, the inflation blame game and the supply chain blame game has been really a focus for the last 2 quarters. We actually think that the second half of the year, there's a very good chance that we see a supply glut. It's not a popular theme, but I'd rather go the opposite way. We get more people back to work and we start to see supply roughly match demand again. I think earnings growth are going to surprise to the upside. And I think this notion of inflation is going to be something in the rear view mirror.
So as I stated earlier in my introduction, the stock market's not off to a great start. Maybe you can help us summarize what exactly happened, how much the Fed had to do with this downturn, and whether or not we can see a rebound from current levels.
Well, the market clearly has been volatile, as you said, and we've had this nice reversal the last couple of days to kind of bring us back. And I think the mere fact that the market was able to go back down and retest those lows attained last week and then rally into the close on Friday on a very short-term basis, and now again kind of continued with that strength, I think that speaks volumes on the near term. From a longer-term perspective, we are still, we believe, in the midst of a 20 to 25-year bull market. That's been our call since 2009, 2010. We've remained resolute with that, even with all the volatility in the fourth quarter. We missed our 4,800 target on the S&P last year by 34 points, so I think that's 0.007%. So we've been pretty accurate, blessed and fortunate to have a process and discipline that works in terms of calling the index. But I think too many people kind of jumped on the negative bandwagon. The Fed clearly was causing some of the consternation and fear. The Fed's doing its job in our view. Interest rates can, will, and should go up, and stocks can, will, and should follow the path of interest rates. Our overall theme for 2022 across everything from stock market performance to interest rate increases to inflation to earnings is second derivative, meaning we've had a very, very strong first derivative move to the upside in terms of momentum, especially with respect to valuations and prices. We think we're starting to see a second derivative trend kind of come together. What does that mean? It means that less positive, the pace of price performance we think is going to be positive, but less positive. Same thing with earnings, same thing with valuation. And yes, same thing with interest rates and inflation.
Okay, Brian, I want to touch on your outlook, or the firm's outlook on monetary policy. Interest rate hikes this year, front and center, headlines everywhere. It's a concern for all investors. Do you agree with the dot plots of 3 hikes this year?
Well, our great economics team is forecasting 4 interest rate increases. There's some people out there doing as much as 7 in terms of their forecast, and even 5. We don't clearly think that's going to happen. I think we're probably closer to 3 or 4 in our view. Again, it's not our call, it's the economics team. Yeah. But at the end of the day, I still think that there are some risks with respect to getting a little bit too aggressive here. I think Mr. Powell is the right person to kind of thread the needle here. And if there are additional fears with respect to either employment gains being weak or what we think that we could see another variant or the pandemic gets even worse again, I don't think the Fed's going to have the right tools to necessarily increase interest rates the way that we think they are. However, we do believe that the Fed is doing its job, and it's actually very good news that the Fed is increasing interest rates because that means that the economy is able to stand on its own 2 feet.
Okay, so let's talk about the implications of this of these rate hikes. Some speculate that growth stocks this year are likely to underperform as a result of rising interest rates. What's your stance on this?
Well, I think that's too simplistic. I think there's a lot of different types of growth stocks. There's dividend growth stocks, there's consistent growth stocks, there's hyper growth stocks, and there's kind of core growth stocks. Given the fact that growth versus value has outperformed for the betterment of the last 10 years or so, right. I think a lot of people are kind of looking for that. You have to remember that it's not a 1 or 2 year event in terms of the transition. We've had a multi-year event. And if you take a look at what happened last year, growth versus value was actually quite close, as was small versus large in the U.S. especially. So I think it's going to take longer than a year for value to take over. Clearly, there are parts of growth that still, to us, with respect to our view, especially growth at a reasonable price and dividend growth, look very attractive. And I think most people want to brush and paint technology with the same brush. We don't agree with that either. So I think you have to have a very strong mixture of both growth and value in 2022. And what you like to say, we call it play the ebbs and flows. What does that mean? When value's been outperforming, sell a little bit. When growth's been outperforming, sell a little bit. So this is the stock pickers market.
Okay, so let's go from the top down here. Your S&P 500 call for the year then currently at 4,400 points, well, almost 4,500 points today. How far can we go this year in 2022?
Our target's 5,300. It has been since we published our piece in November of last year of 2020. I'm sorry, 2021. These years are just flowing together.
I know.
So 5,300 and $245 of earnings. I believe that we're one of the highs on the street. I kind of like it when we're out there and not everybody agrees with us. It kind of creates for more market activity. The last time everybody was in agreement with respect to being bullish was 2018. We saw how that worked out. But we still think that stocks in the U.S. and Canada are the best assets in the world in terms of equities. And we think that there remains a lot of underinvesting with respect to U.S. equities from a foreign perspective. Yeah. And remember this too, we have not had the great rotation out of fixed income and into equities, which we've been looking for at least 10 years or so. Remember, bonds have been in a 40-year bull market. I don't think people talk about that enough. So I do think at some point during this big 20 to 25-year bull market, we'll see that rotation out of fixed income and into equities.
People talk about finding growth and yield in a low-yield environment. That might come to an end, the low-yield environment that we've had in the last 10 years or so. So rotating from bonds into equities, is that still a fair play right now? Wouldn't you want to go back into bonds now that yields are rising?
I don't agree with that. We're heading out of a low yield environment, my friend. If you take a look at the average 10-year treasury the last 70 years is 5%. Okay, so let's take a deep breath on that. The average 10-year treasury since the great financial crisis is 2%. Mm-hmm. Now, last year at this time, if you remember, everyone was convinced we were going to 3% in the 10-year treasury. How'd that work out last year? And so I do think that it's going to take time to quote unquote normalize interest rates. And in the meantime, the Canadian market certainly is in a fantastic position to provide equity income growth, as is the United States. But Canada, given its lineage, of course, of the UK, has always been a market that has done very well with respect to paying dividends. Again, the U.S. is starting to catch up a little bit. So I think dividend growth and income growth is a very, very key strategy.
Okay, let's touch on Canada briefly before we move back to the U.S. Now, Brian, as you are aware, the Canadian stock market is intricately linked to the resource sector. So let's get your pulse on oil, the energy market, and raw commodities. Where do you see this space headed?
Well, we don't think commodities in a super cycle. You need to have both materials and energy going up together. We think actually materials could do quite well in this kind of every other year outperformance cycle. Remember in 2020, materials did very well. 2021 clearly was the year of energy. There's been a lot of momentum in these energy stocks, and we recognize that. But given the fact that we do believe inflation is going to be peaking sometime in the first 2 quarters, and we see some more production come on. Supply has clearly been well below demand, so demand has outstripped supply for several quarters in a row. We haven't seen that in historically speaking terms for several decades. So we do think some more supply is going to be coming on the market. So oil prices, we believe a year from now, will be lower. Be that as it may, Canada's fortunes are not tied to the resource sector. In fact, if you take a look at how Canada performs, it really needs 2 or 3 of the big 3 sectors, meaning energy, financials, and materials, to outperform. Now, last year in 2021, it was financials and energy that outperformed. And typically, when you have all 3 sectors outperform, it outperforms the S&P 500. And so, meaning its neighbor to the south. So we think Canada's fortunes are really tied from a longer term perspective to those sectors that are tied to the U.S., namely technology, industrials, consumer discretionary, especially.
Okay. Do you have a view on the Canadian dollar versus the U.S. dollar?
Given the fact that we've seen a very strong oil price, the Canadian dollar, the loonie, is tied to what happens with not only WTI, but Western Canadian Select as well. So we still see continued firming there. I don't think we're anywhere near what we're going to see par or premium. I think that happens if and when we have a commodity super cycle, which I think we're still several years away. We need to see more significant signs of global synchronized growth with all the commodities kind of moving together. I think that's the better chance that we see the loonie really gain some strength.
I just want to touch on that real quickly, because you mentioned this several times that you don't think we're in a commodity super cycle. That, of course, runs contrary to a few economists have had on the show. I'd like to get your take on whether or not, or why you think a super cycle is not yet happening.
Because it's 2 commodities, right? It's natural gas and energy. There's a lot of other commodities. You see how gold's underperformed. You've seen what's happened with silver and palladium and uranium. We've seen decent things with respect to the fertilizer complex, but look at paper prices in 2021 were very volatile and not following the same path with respect to oil. So when you have the CRB metal index, CRB index, and oil and gold all kind of running together, that's a commodity super cycle, not just because energy has doubled. Remember, in March of 2020, energy companies were paying you, to take physical delivery of oil.
That's
right. And so I think we've forgotten that. And let's just take a deep breath. Doesn't mean that we don't like energy stocks. For instance, we think energy companies in Canada, which has been our call for the last 10 years, are expressly attractive assets compared to especially U.S. energy companies. So we continue to favor Canadian energy companies over the U.S.
Okay. Let's tie it back into the U.S. now. You have a chart here from your latest report. It shows the price to trailing earnings of the S&P 500 plotted against the top 25 S&P 500 stocks by the lowest PE ratio. And you can see here that the S&P 500, that PE is much lower than that of the top 25 stocks. What does this chart imply?
Well, it implies that you want to be a stock picker and kind of diversify out, not from just the top 25. Now, clearly, many of these top 25 stocks are technology names, and these are the same names that have led the market for much of the last 10 years. And I think that's why you kind of have to be more careful and not make decisions on the index level, which I think is the number one mistake from investors right now, trying to make market calls instead of being an investor. And so the market actually has become more discriminate with respect to what it's doing with high multiple stocks, meaning kind of correcting those. When the market becomes indiscriminate and kind of takes everything back behind the woodshed, as we say in the old days, that's when that creates the best opportunities, but that really shows that the market is more driven by fear and rhetoric.
Okay. And of course, your top sectors, let's go over that. Top sectors this year, given your macro outlook that we've already discussed.
Well, we're overweight the same sectors in both the U.S. and Canada. So financials, consumer discretionary, materials, and industrials over the next 3 to 5 years, because we have the very good fortune of running real live equity portfolios for BMO. We look at a little bit longer term in a couple of portfolios, and our favorite sectors are technology, communication services, financials, and discretionary, where we take a little bit more of a longer term and have a little bit more riskier positions because they're smaller. But at the end of the day, we think those are the growth engines for the next 10 years. Over the next 12 to 18 months, we do want to be a little bit more cyclically oriented and more toward that value component.
I would like to get your take on technology stocks and your philosophy around technology stocks. Like you mentioned, their PEs and other valuation metrics are higher than other sectors. First of all, is it even fair, because I hear this from other economists and analysts all the time, that technology stocks are overvalued compared to any other sector, but is it even fair to compare sectors across like that? And second, your view on technology valuations as a whole right now, where do you see the space headed, and why are you still, long-term bullish on tech?
Well, you probably have a semiconductor chip in your tie right now. Semiconductor chips are going in everything. And if you take a look at how people try to paint the technology sector in one brush, meaning the triple-digit price of sales companies, don't ever talk to an economist about valuation anyway. They're not investors; they're economists. Their job is to continue to forecast and then reforecast. I mean, no disrespect to economists, but they're not investors. You talk to portfolio managers or analysts or strategists. And so I think there's a big mistake making valuation calls on the technology sector right now, and especially comparing it to 2000. There's nothing to do with the market right now relative to 2000. Let me just state that, number one. Number two, there's several sleeves of technology stocks. There's the secular growers, there's the structural growers, there's the cyclical growers, and then there are the more defensive growers. I didn't even name the high-flying growers, which is the fifth sleeve, which everybody seems to believe that's all that tech is. And so those secular growers are the ones where we're spending our money, whether or not it's Amazon or Apple or Microsoft or Netflix or Google. This is where we're spending money as the consumer. The structural growers are the NVIDIAs, those types of names, the Adobe's, Salesforce, the up-and-coming type of growth stocks. The cyclical names are more like Intel, and the defensive names are Cisco and Oracle. So there are names in that area that pay very strong dividends and will continue to grow the dividend. And I think that is way understated with respect to the market when they talk about technology names.
Here's a view that I got from a technology investor. He runs a fund that primarily invests in tech companies, and he told me that valuation metrics, traditional valuation metrics like price to book, price to earnings, they're trailing indicators that don't really factor in the intellectual growth potential of tech, which is the core of their value. If you're buying a company like Tesla or Apple, really you're investing in the intellectual growth potential of their IP. And so, you're looking at something like price to trailing earnings. That doesn't factor that in at all. So he's just ditching valuations altogether, and he's not looking at tech from a valuations perspective. Is that a viewpoint that you necessarily subscribe to?
No, I think it's too binary. I think you do have to look at valuation. Valuation does matter, but trailing is already what happened. You have to look at forecasts as well. And valuation is the world's worst predictor of future performance anyway, across the market, across individual stocks. So I think that investing is kind of like a big pot of potpourri, where it's got a lot of different smells and a lot of different things in there. You got to mix it up. You can't just focus on one particular attribute. That's why I think people making simplistic valuation calls on technology are going to end up getting burned. Okay,
excellent. All right. So your top investment advice for investors this year?
Stay invested. Stop listening to the rhetoric and fear. Build portfolios from the bottoms up, the more active as possible, and really believe in the consistent growth factors that we, especially in the United States, afford relative to a much more volatile rest of the world.
All right. Brian, I appreciate your thoughts as always. Thank you for coming on Kitco. I'll speak to you next time.
Thanks so much.
Thank you, Brian, and thank you for watching Kitco News. I'm David Lin. Don't forget to subscribe to our YouTube channel.